Okay, folks, welcome back. Midweek review for June 26th, 2019. Man, is this year flying by. I don't know about you guys, but this year has been really fast. And I guess as I get older, time seems to be speeding up. A never-ending reminder of mortality. Always reminding us. So anyway, looking at the dollar index, this is our daily chart. It's our daily chart of the dollar index. So we've created a fair value gap in here. Yesterday, we traded back up into about the midpoint of the consequent encroachment. There has been left a SIBI, sell-side imbalance, buy-side inefficiency still there. It looks as if it might want to go up and fill that. The draw on liquidity still for me is the sell-side liquidity resting below this low. So the two or three things that can happen here. One, it can fail that to make a higher high than yesterday and roll over and trade for it into Thursday and Friday of this week, or we can come back up and trade into the SIBI and bounce around sideways going into the close of the week, or we can come all the way back up and touch this low and close in the SIBI that remains below this low in this single candle. Now, the reasons why there's three specific conditions that could happen, that's what causes me to have a very low probability or directional bias for the dollar index. Now, if I zoom out a little bit, I want to kind of remind you of something. We talked about how the dollar could just bang around and go sideways, even though we've had a move from the 98 to 96, 95 and a half. Let's see what that low is. It's basically 34. So about 300 pips or so, a little bit less than that. In terms of a range for dollar. We haven't seen a lot of volatility for the dollar index this year so far, so it may be heating up for the latter portion of the year. We've obviously moved beyond the midpoint of 2019. This fall, hopefully, will be a little bit more volatile for the greenback, but it also allow still foreign currencies to expand. In other words, they're manipulating dollar very heavily here. Even though we've had a decline, it's been really controlled. Hasn't been a lot of accelerated selling, and there hasn't been any kind of breakdown, if you will, of the over long-term structure of the bullish dollar index. Now, even though I have a very near-term, short-term horizon that is bearish for the dollar, and again, reaching for this low in here, will it get down to this low here? I don't know. I don't feel that it needs to do that. It could just come down here and sweep this, and then continue to stay within the range defined by the high here, and whatever low it forms once it takes this low out. So, while I'm long-term still dollar bull, near-term, as we mentioned last week, we were looking for sell-side opportunities, okay, seeking liquidity resting below this low. If we take this low out, then that would more or less put me on a slightly short-term bullish with a long-term bullish outlook on the dollar. So I would have two time frames, kind of like in sync, looking for the run on liquidity and then a run back up higher into the range. If we leave this open, this SIBI here, it's not noted or identified like this one is here. If we leave this open after running this low, that would be my near-term bullish objective. Now, that's what the chart is showing me now. This is all subject to change based on whatever the market provides me by way of price action. But for right now, the conditions would be if we run the sell-side liquidity, I would expect it to come back up and hit this breaker. Now, what makes this a breaker? We have a swing high here that ran higher, taking that out and closing a fair value gap as well. So if we get that run on liquidity here, I'll have short-term and long-term in the same directional bias, which would be bullish. Okay, and now I'm not stating that we're going to run this low and come all the way up and clear the equal highs. I'm just saying for the near term, I would be looking for a run back here if they leave this SIBI in place, sell side imbalance, buy side inefficiency. Because of the other two scenarios, we could roll from here. We could roll from here or come all up and close this in. I'm still unsure for the dollar. Now, it doesn't mean we can't take opportunities in foreign currency. This means right now the dollar is just dicey. Okay, it's 50-50, and I don't like 50-50. So we have to rely heavily on the individual foreign currency pairs for our analysis, which is lower probability, but still it doesn't mean that we can't operate or practice in them. If we were trading with live funds, one would consider obviously dialing back the amount of leverage and not exposing their account to a great deal of risk because of that. Not that you'd ever open yourself up for larger risks anyway, just means that you would be much more prudent with managing the risks associated with this specific condition. Again, day traders market, hate to say it over and over and over again, but it's the mentorship. You're learning the school of thought and what makes these environments what they are and why I call them what they are. All right, so there's really no need to go into the lower time frame for the dollar index because everything I've just mentioned here is the salient points. Near term, we have the buy-side liquidity pool resting just above this high. It could just run the rejection block, which is this highest up close here, and that would be 114.27. So we'll look for 114.30. Me personally, I'd like to see it run this high because if it does do that, I think that we will make a much broader attempt to challenge this high, and I don't know how or what structure would be required to do that. Now, if we run this week or into next week into this buy-side liquidity pool and expand with a great deal of momentum, if we take this high out here, then we have created the low of the year for Euro. I'm convinced of it at that moment. Right now, we're still inside of a larger trading range. It's not really doing much at all. It's just bouncing around. Now, this could have been the smart money, if you will, entering the marketplace, okay, and creating the market structure shift here, and then a return back to fair value gap, running sell-side liquidity before it does it, and then it expands on the upside. We were targeting these equal highs here and here before this move, so we had that in our favor. I'm not convinced that we're done on the upside. You do have a little bit of BISI in here, buy-side imbalance, sell-side inefficiency, and we do have one in here. I don't feel that we need to come back down here because we already had this run here and a deep retracement. Then we had this run creating another range high, breaking these equal highs. It would be reasonable to see it come down in here, but I don't think it's necessary, and it certainly is not necessary for bullish to come back down to here. I don't feel that that's necessary at all. So we'll be looking for some range expansion to continue into the end of this week, maybe rolling over into next week, attacking the buy-side liquidity here, and then seeing what type of price action we get above this high to warrant our study of this old high here. If we zoom out just a little bit, you can see it's really been a quiet year. We haven't had a whole lot of volatility for this pair, and I haven't had a whole lot of interest in it either. But if we zoom out a little bit further, you can see we've pretty much done next to nothing in terms of volatility. It's really, really slow. But I will say this. If we do, if we do take out this high here, this low will be in for a while. And we have these equal highs to consider here. We have a fair value gap over there. There would be a target. This would be another target, and this would be a target up here. So it kind of puts you in line with what could potentially happen. Okay, so it could get really interesting if we take this high out. But until then, we're stuck inside this large range, and I'll just highlight that from a graphic perspective. We're stuck here. Okay, we're inside this range. We've been doing it basically all year long, and nothing terribly exciting has happened. Now, it doesn't mean there hasn't been opportunities. Day trading, intraday scalping, it's there. You can still build the account out building that small little micro increments, but it just requires a whole lot of work. The hourly chart, let me take this off. We drop down into an hourly, and we'll put our notes on for fiber. We had a buy-side liquidity pool here, equal highs mentioned, ran through that. We had a mid-figure 50 level. We can expect 40 pips beyond that once we run there. And then we go into the big figure. So we went all the way up to 114, 114.11-ish. Okay, so really, dynamic run above these equal highs. We are not anywhere near. We still got 45, 50 pips more to go to that daily high that I mentioned before going into the hourly chart here. So even though we've had that run, this could be the consolidation, kind of like a larger version of this smaller consolidation where we ran up, consolidated, and then expanded. Well, we ran up, now we're consolidating, and we might be in store for another expansion on the upside to take us into that 114.50 level and maybe even higher. So, gun to my head, like I said, I'm still leery on near-term dollar strength. I think anything in the dollar near-term should be sold until we take that daily low out, which opens the floodgates for bullish scenarios on foreign currency. Euro dollar may be the sleeper, okay, meaning it's the one that's being really quiet right now, and then euro dollar could be the one that explodes later on in the year after trading so quietly in the first half of the year. So just be mindful of that. If we move into a 15-minute time frame, keeping everything as we see it here, we had a little bit of a BISI here, buy side imbalance, sell side inefficiency, which rebalanced back to the mid figure. Several attempts to trade lower there, and then we had a run above equal highs. Now, to go below these equal lows doesn't really need to happen because we don't have any inefficiency here because this is all part of one single fractal. So it's a balanced price range. We had both up and down there. We don't need to come down to fill any of that. So if it does go lower, to me, it would negate any near-term bullishness because I think that they'll want to take it a little bit more deeper than just a 10 pip or 20 pip run below the mid figure. So I'd like to see it find some accumulation in this range in here. We have equilibrium at the high and low of the range here. Small little, if I zoom in, a little bit more helpful to you. We have a little bit of an inefficiency there, not a whole lot, but it's also overlapping with the two down closed candles that make up a bullish order block. So we want to be watching that 113.60, 113.55 level. See if there's any kind of reaction there. If we get it on the upside, we'll be attacking, again, the highs that were created yesterday, relative equal highs. So we would be attacking 114.20 institutional and then expand 30 pips to get us into that 114.50 level, which would also very efficiently take out that daily high that we've identified on the daily chart. Rolling over into cable. Cable, the upside on intermediate term, should we get legs on the upside, remains at this old low. I mentioned study this fractal here, that we would probably create a very similar pattern where it's moving back like this, back and forth, but I said we wouldn't go below this low. Okay, we have the low, the lower low, and still consolidating in here. So it looks exactly like this, just over here. And I think that it's more likely to expand on the upside where we're at now than it is to go lower. We had 1, 2, 3, 4, 5 times we tried to go lower, and we've rejected it. We had a break in market structure. I don't require close above. So we do have a market structure on the upside. There is a small little imbalance here with the bullish order block. It would be better if it doesn't go down there. If we trade down here, the probabilities fall precipitously on this being a run to this old low. It would be better to see it trade from where we are now, just turn the corner here and start to run up into that 128.65 level. We drop down to an hourly chart and zoom out just a little bit and put our notes on for cable. Alright, so we had buy side liquidity pool here, equal highs, and I mentioned last week before the start of the week our buy side liquidity pool would be targeted in the beginning of this week, and we see that happening here. The high was 127.62. We had a 20 pip run perfectly and then rejection, and we have a fair value gap right in here that overlaps with a breaker. So if we do get a pop up in here, don't be surprised if we see some short-term rejection in that area there. It doesn't need to, but this also will create another potential support area should we trade back above it. If you come back down into this level, it could act as support and then see it go higher. So again, we're using fair value gaps in the future, even though they've been filled. Like I mentioned over the weekend review, fair value gaps are not to be forgotten. Okay, they're very meaningful IPTA will want to revisit them even after they've been filled in, because now they're a balanced price range, which makes us a natural support or resistance level. So where we're at right now, I don't feel that it's necessary to come down, but if it does come down, we have a fair value gap in here, and the next one would be right in here on this order block. So again, I don't want it to come back down into this area here. There's no need to come back down into the 126 big figure. I don't think it needs to do that. I think it needs to stay above 126.50 in my personal opinion, and I'd like to see it do that and then maybe find some further legs on the upside. 15-minute time frame. There really isn't a whole lot except for this right here. Now, at first glance, this may look like it's been closed in, or not closed in, but has been efficiently traded to, or traded between the open and this point here of this down closed candle. IPTA starts the inefficiency when we're doing a down move like this, where one single candle creates the range that creates our, in this case it creates our SIBI, sell side imbalance, buy side inefficiency. You want to go back until you find the next or the first up close candle. This delivery on the upside was here. Once that up close candle is broken on the downside, that begins only the sell side delivery. And reverse is said when we're looking at areas where price has created a down close candle, and then we have one single range on the upside that creates a BISI, buy side imbalance, sell side inefficiency. You want to use the down close candle, which is really the theory of my order block concept. So high probability order blocks are going to have associated fair value gaps with them. All right, so with that said, we're really doing nothing but chopping wood in here. We're stuck in this small little dealing range. Nothing terribly exciting for cable at the moment. But again, everything can change, and it's probably what will happen. It'll be a sudden shift, and we'll have a big displacement, which is welcome. We want that. We want to see the banks step in and really send price at a stark contrast to where we are right now, which is low volatility. We get a big rock thrown in the pond, we're going to get a lot of ripples, and those ripples will create imbalances, inefficiencies, and liquidity pools, and that's exactly what we look for to have high probability setups, because they're going to be targeting large fund traders. Large fund traders are going to need positions to be protected, and those places for protection are going to be very logical liquidity pools. Right now, it's not really logical, it's not really clear, it's not high probability. So we have to sit on our hands and wait, and there's nothing wrong with that. It's absolutely within the realm of prudence. It's in the realm of maturity as price action students. We know this is part of the game. We know what we're supposed to do, and we wait. When the criteria is there, we will jump on it. But until then, we wait. We are looking for a shift higher or lower. It doesn't need to be what I would like to see it happen. It could be anything. It could be, a direction that would be opposite of what I would rather favor. Once you get that imbalance, then we know what we can look for. But until then, this is what some of the newer students struggle with. You're thinking to yourself, I don't know what I don't know what I'm waiting for. Well, if you go back and listen to all the previous recordings and reviews, I give you the situations that I would like to see happen. Sometimes they don't form. Something else forms. But then I can get in sync with IPTA, and then we point to where it's going to go next. These reviews on Wednesday and the end of the weekend, they are for your learning and edification, obviously, but to kind of like keep you on the right side of the liquidity relative to the daily chart. And I kind of like break the daily chart down into the 1 hour and the 15-minute time frame, skipping over the 4 hour because it's kind of redundant. It's not that you don't need it or you shouldn't have it. It's just I'm saving myself a big step because I know what I'm looking for that I can see on a 4 hour with a daily and a 1 hour. For you, you should be incorporating that 4 hour chart too, so that way you have a little better visibility, because I'm leaning heavily on my experience. You don't have that, so when I drop from the daily down to the 1 hour, don't get in the routine of ignoring the 4 hour, because there's going to be sometimes the 4 hour is going to be very clear about where a imbalance really is that you may not see on an hourly chart. I can see it because of experience, but you may not understand certain things that I may point to because I'm either trying to get through the video expediently because of time, and like now because it's payment season, everything kicks off today. So if you paid early, we've gone through a great deal of those payments already and processed them, but we'll be working on them until 8 o'clock tonight my local time, and then we'll resume again 5 a.m. And again, we're processing them in the order that we receive them. So please don't email and send me, hey, I paid early. Wine, I got it. It takes us a little bit of time to get to you. Again, reminder, it's early. You're paying early to get earlier access than the first of the month, which I greatly appreciate, by the way, because it helps me get through it all. But we're looking for, right now, price to want to resume higher. In my opinion, that would be the better scenario. Obviously, it can trade lower, and it would create new opportunities and liquidity, and we would attack that. But right now, we have to sit on our hands, which takes us to the market I said we would look for a run on the lows over here. First this one, and then over here. We had the sell-side liquidity pool ran last week here. Did that beautifully on Friday. We had a little bit of a retracement. Didn't quite get up in there. I said it could get up in there. I would look for something to do that, but it didn't get it. We're really heavy on dollar CAD. And then we had an expansion on the downside that swept that liquidity pool here today. We had a breaker relative to this price swing here. I just have that on there for notation and completeness sake. Dropping down into a 4-hour. Okay, we had a fair value gap here. A little too crazy with the zooming out, didn't I? Let me zoom in a little bit more. Just go a little bit more than that. There we are. So on the 1-hour chart, we had a fair value gap here. Price trades up into it, spends a little bit of time here, a couple hours in there. 3 hours, it spends time and then moves away. You want to be shorting in this area, but again, when you do that, your stop goes here. Okay, or if you want to be a little bit more nimble and take advantage of leverage, this swing high here. So you have to have a stop that would be above this high if you're going to be really, really aggressive about your leverage and what you're willing to take on, or you want to be a little bit more conservative. Your high here would be used for your stop. So a fair value gap here, trails lower, it takes the low out. Once this breaks the low here, then and only then would you start considering moving the stop loss, not down to break even, but just reducing it a little bit. But you have to break into a new range or outside the dealing range before you do that, which is first profit. Okay, so that's how you know when you're taking first profit. These are all points for your notes. Okay, these are all gems for you to have answers to your questions, because I'm answering a lot of them as I'm talking, and sometimes you're not paying attention because you really want me to point to what it's going to do next. And all those things that I'm doing to illustrate those things before it happens is because of the things I'm teaching. Because that way you don't require me to say what it's going to do. You already know what I'm going to say, and that's how you know you're advancing in your understanding. Relative equal highs in here, and we have this run here, and this is exactly the reason why I say you have to slowly work your stop down. Don't be in a panic to rush it down. You appease that need to be right by taking partials. Over time, you'll learn to take less partials. In other words, taking partial profits off your positions, because you'll have a greater understanding of what it's going to do. Leaving more of the position on and taking a larger portion off at full target. In the beginning, it is essential that you take partial profits because you're learning. You need to learn what it feels like to be in a trade, but still not require yourself to be correct or needing to be right. And this right here would upset a lot of people if they would have moved their stop loss right above here. We have a lot of equal highs in here. That's an obvious level of liquidity pool. So they run that. Price doesn't run this low here until there. Then and only then can you bring your stop loss again to a point at which where it would be break even. You don't want to be terribly excited about removing 100% of the risk. Okay, this is all part of the game. There's risk always. Even when you move your stop loss to a positive level, it can gap. And folks, believe me, I've experienced that. It's not fun. And sometimes, when I would take a position ahead of the report releases or FOMC, or even when I was trading non-farm payroll, the amount of slippage would be extreme. Okay, and if I had large positions on, it'd be very painful. And that's not fun when you're taking big hits with large real money trades. The next area here, we have fair value gap as well there. And trades right to the 62 level. Let me get it to, there you go, 131.62, which is defined by this high here. Okay, so it needs to trade, once it trades it down, you can trade back to 62. Again, remember, institutional order flow entry drill. We're just needing it to trade right back to the low of the gap. Once it trades there, that's your fill, because we don't know, and I'll show many examples of this, we don't know if it's going to go inside the gap at all. And to compensate for everyone's broker, that's always going to have something different in terms of this particular candle here. Like if you look at this candle right there, I guarantee you, if we did a poll on everyone's hourly high on this particular candle, they're not always going to agree. Some may be a little bit higher. Some may not even go on to this point here. Maybe something else. But we used a fair value gap low. That's our entry. That's the price we're looking for. If you want to be really sure that you're going to get into trade, go the spread below that. And that would be your entry. Again, the same premises. You find a swing high, which is swing high here, or this one. And you got to go be above that for your stop loss. And then seeking the low, which is that old daily low here, which is sweat. It was very, very shallow, but nonetheless it did what we were looking for. And that's that run here. And now we're consolidating. So we created a little bit of a fair value gap in here, basically almost filled it in here, and we could see one of those classic bear patterns, okay, or bear flag. That might be the scenario that we have here, because we could be consolidating, come up in here, closing this, and then maybe make a run Thursday and Friday to close this then, and then go to like maybe 130.65, maybe 130.50 if it wants to expand below that. So dollar CAD's been performing nicely for us, even though that euro and cable's been pretty lazy in its price action. So, but that's how we do it. We look for two pairs that we follow very closely, and if we don't see anything there, we move to an alternative. My alternatives are dollar CAD and Aussie dollar, and that's the procedure. That's the protocol I follow. I've been doing it for years and years and years like that, and it's working. So it's not a whole lot of big movements, but you don't need a lot of big movements anyway. All right, so now I want to talk about the lesson for this midweek review. And I want you to think about the levels we look for liquidity. When the price draws to points of liquidity, like a fair value gap, or a order block, or a old high for buy side liquidity, or an old low for sell side liquidity. It's moving to these levels to absorb, purge, or engineer liquidity. Those points at which, in terms of time, when it hits these levels, it's allowing banks to play counterparty to speculators and large funds. Okay, so the banks aren't seeing your particular stop, whereas like your local broker can see exactly where your stop is. The interbank market isn't necessarily seeing your stop. It's seeing where large fund traders' stops are. They can absolutely see those. We're too small on the radar screen to be considered even interesting, but they don't need to worry about it, because the way they move price around, it acts like a big fishing net where it just catches everybody. Okay, so years ago when there was this big uproar about how tuna fisheries, these fishermen that capture tuna, They use these huge nets and they dredge across the ocean, okay, and they pull in everything. So yeah, they're catching tuna, but they're killing dolphins and every other wildlife. While I think that's unfortunate, that's exactly what goes on with the interbank. The central banks move price around, and they know if we're the dolphin, okay, we're just out there doing what we want to do playfully, hopefully trying to survive. The tuna is like the large funds. They want to capture them. They want that bluefin tuna. They know we're going to do what essentially the large funds are going to do with their stop losses. Above and on high, okay, wherever there's an equal high, they're going to see that as resistance and feel safe with their stop loss above that. And you know the routine, you know the whole procedure with retail thought process. So they're not concerning themselves with us. They are attacking large liquidity pools, because those large liquidity pools, if you study, again, I've mentioned this before, if you study the Commitment of Traders report and graphically study the net trader position chart that is used with that data, you can see the large speculators and the commercials are always 100% diametrically opposed. They are always dancing perfectly with one another. Wherever they're going lower in the large funds, commercials are going down. Okay, in other words, whenever the large funds are going higher in their long buying, commercials are selling it to them and they're increasing their net short positions. They're always 100% diametrically opposed because they're playing counterparty. That's what creates the amount of precision and accuracy to our methods, because we wait for periods when those moments are so obvious. We just stick with that narrative until there's something that's significant that upsets it and changes it. When these pools of liquidity are tapped, okay, they are usually intermediate term reactions, and that's what we're looking for, intermediate term reactions. What I'm going to talk to you about today, and I'm only introducing it so that we can really go into the charts for the rest of this week, and then on Saturday when we do our weekly review, and as a reminder, I will have the review again Saturday, not Friday. So the children are out of school right now. We have a event that we're taking part in on Friday as a family, so I won't be able to do the recording for the weekly review Friday, but it will be on 4 p.m. Saturday, my local time. But I will give you examples, much more detail than we're doing here, but I want to give you the idea, okay, so that way I won't rob you of the discovery and that moment of astonishment that I got when I really went into the charts and started looking at it. Intermediate term reactions are the real key. That's what we're looking for. That's going to be seen with the daily chart and the 4-hour chart. So we're going to start on, and this can be done on any pair or any market. It doesn't matter. It's not just a Forex thing. It's a trading thing. Okay, so don't think that it only works with Forex. I was doing this stuff with the S&P and the bond market for years and years and years. Everyone knows what a swing high and a swing low is. It's pretty basic stuff. If we go out to a blank chart, just a complete default chart, I want you to look at how the market moves from here to here to here, down to here, and I'm not going to do this the entire chart, but I just want to give you a feeling for what intermediate term price reactions look like, not just the tiny little fluctuations that gyrate here and there, where significant price turning points occur. When we see things like this, or when your eye sees moves like this, when price goes up into these levels, they're not random. Okay, there's a specific reason for them going there. Now, if I were to draw these on here like this, there could be a million different reasons why you would attribute why price went there or why it reacted as it did. But knowing what we see here, if I take these off, now that we know what an intermediate term price swing looks like, again, it's typically seen on a daily or 4-hour. Okay, that's what makes it intermediate term. But this return up to here is simply closing in a fair value gap here. So I'm going to give you, obviously with the benefit of hindsight, but you all know these things, and you can see examples in our commentary where we've already anticipated these things that occur in the past. Maybe not so much for this particular here, but in many examples in the cable and dollar and cable, I'm sorry, in fiber, because they're markets of choice, or mine, I should say that. We have a bullish order block here. And then we have another fair value gap here. Right there. So this single candle down gets rebalanced here. So, and again, we have a fair value gap there, which I'll use a different color just to highlight that. Right in here. Just a slightly different color. Now, back in the 90s, right before 1996, I was looking at things like this on the bond market and the S&P. And a lot of my charts would look something like we're seeing here. Every one of my ranges, though, because I could have on Supercharts and on Metastock, which were the two platforms I was working with at the time, every one of my ranges here would just simply be a shaded in Fibonacci and the midpoint, which is where that dot is showing here. Whenever you highlight a rectangle, you'll see the dot comes up right in the middle. And right there. I would have that 50 level in every one of my ranges. So that's consequent encroachment. Now, consequent encroachment is the mean threshold of a gap, whereas mean threshold of a candle that creates the order block is, well, that's mean threshold. It's not mean threshold in a gap. It's consequent encroachment. It's the consequent, or what's permitted, okay, or what's reasonable in terms of trading inside of that gap. It's encroaching on the entire gap closure, but it doesn't need to. So we're trading on the premise that the midpoint of the gap is all that's necessary. So now, with that in mind, when price is trading up into this area here, okay, or trading up into this area here, or trading up into this area here, okay, when we have that expectation, the study I have and have had for 20 years plus now, if I'm expecting this to rebalance in here, or expecting it to rebalance in here, or here. Once it starts getting to consequent encroachment, I'm going to be looking at the candles and how they form wicks. Okay, I removed a goober from our group that was very ignorant on the forum, trying to be a comedian, and he assumed falsely that the rejection block that I talk about and I teach you is nothing more than a pin bar. Okay, and I'm going to draw the distinction here so that way you guys can clearly know that he was full of crap and doesn't know what he's talking about, and he's been since removed. And I guess really that should be. Yeah, we'll use it like that. So I'm going to draw a very crude depiction of a pin bar. Now, pin bars to me aren't terribly important. I don't care for them. I don't trade them. I'm not a one candlestick kind of guy. So if we ever see a price create one big wick and a small little body, this is a bearish pin bar, okay, or a bearish doji. Okay, you can look at it like that. A bullish pin bar would look like this, where price goes down and creates a low, and then comes all the way back up and closes, higher. Again, this is not what I'm teaching you. Okay, this is nonsense. This is stupid. Okay, it doesn't mean anything to me. What I'm teaching you is to look at this. I want you to see when price creates this scenario. Now, these candles can be up or down, whereas the pin bar theory, if you follow that stuff, you want to see the close higher to be a bullish pin bar, and a close lower if it's a bearish pin bar. And again, I'm not trying to teach that. I'm just showing you the stark contrast between the two. And this thing's going to fight me in it. My OCT is flaring. I want it to be where I want it to be. So we'll have to do this. And that's just going to have to work for now. All right, so we have a candle prior to another candle with a wick. There's two things that IPTA will do when it creates the rejections in here after it goes to an area of fair value gap. It can be, now it's not limited to, okay, this is not limited to how it trades into fair value gaps. Okay, so this phenomenon doesn't just lend itself to when fair value gaps fill in or when the consequent encroachment of a gap is closed. It's at a order block. It's how it trades above an old high or old low. Whenever it attacks a point of liquidity. Okay. Once we trade to these PD arrays that we learned about in month 5 and month 1, the formation of the candles and how they form their wicks is important to me, because I'm going to be studying the gap that is the wick. Okay, so what do I mean by that? When we have a bullish scenario, okay, and really I should probably look at bearish scenarios because we got several of them here. So let's do this. As you can see, I'm not scripted. All this is going by off the cuff. So if you have a candle, and if we weren't in payment season and I wasn't helping throughout the day like I am, I would have made slides, but that's what I'll do for Saturday's presentation. For now, I just want to give you the crude idea, and that way you can go into the charts and have a little bit better study about what it is I'm showing you. Because once you see it, it's very fascinating, and it's you'll see right away. Just give me a moment here to outline this. So when we're bearish, okay, or we're expecting price to move up into a premium array, fair value gap, okay, in his case it's a SIBI, sell side imbalance, buy side inefficiency. When price trades up into that level here, okay, I'm watching to see how the candles form a wick. This candle forms a wick right here. Okay, let me zoom in a little bit more. So this candle creates a wick. See that little wick right there? This is not a doji. This is not a rejection block, okay? This is this formation here. Watch, I'm going to show you. If we get a wick on a candle, once we reach consequent encroachment or touch it, I want to see a wick form on the candle on the time frame that the fair value gap is understudy. For instance, this is the daily chart. When I see this, okay, when I see this, I'm looking for the range from the body. It can be the open or the close. Again, forget the whole pin bar stuff. It's not important. The theory is that the wick that's created on this candle, the very next candle, if we get half, okay, right here, this would be that level. I extend that out in time 3 more candles. Okay? This level, to me, is important because it's the midpoint of the initial gap that's outside of this candle's body. So many times you're going to notice that IPTA will do this. IPTA will create a candle that will move the next candle right to that level, and that will be the extent of the daily range high. Okay? The caveat to this is if we trade above this candle, the daily high will be twice the wick. So the high of that wick becomes the midpoint or consequent encroachment. Then you would do 2 measurements up, which would be this level here, and that would be the high. Now you're probably saying, oh, this doesn't mean anything. Watch. Look at this candle's high. Okay? We're going to look at that specific candle right there on March 6th. And then we're going to compare what it does on the 7th. But before we do, I'm going to zoom in as tight as I can get it. Noting the close to the high. Okay, and it's going to have to be good enough for now. And we'll see it when we get in the lower time frame. So there's that candle. Once we're above consequent encroachment inside of a fair value gap, we're going to be looking for signatures. Okay, this is what I'm teaching you here. One of a very, very high-end theory, but they get way more complicated than this. But I'm testing your resolve to stick with the advanced stuff because it gets really, really, really precise. This candle here, March 6th, we're going to drop down into a 15-minute time frame. So what we've done is we've measured the wick of this specific candle right in here. Okay, and now that whole projection of range is added to it from here up. So all this is, and I'm going to show you what the fib level is because I'm sure you're going to be asking or dying to ask me. This is all that it is here. Okay, and this is only because I'm doing a video and it's part of the teaching, but you don't need to have this. An inner circle trader level is the 50% level. Okay, optimal trade entry is what you would normally expect. So, and then the swing target is 1. That's this level here. Watch. Boom. There's the high on the 7th. Okay? High on the 7th is that level right there. You cannot, absolutely cannot get any more precise than perfect. It's perfect. Now, that's when the candle creates the expansion after the initial candle high. So what do I mean by that? Let's go back out to the daily. We have price entering the closure of the consequent encroachment on a fair value gap, or it could be trading into a bearish order block. Say this is the level that we would have highlighted as a bearish order block that we're reaching up into. Okay. Whenever I say that's the next draw on liquidity, just think this whole formation is likely to occur with the specifics of the candle. Remember, I promised you how to pick daily highs and lows and know what they're going to be. This is part of that promise. Bearish order block. It could be an old high it trades above. Okay. It could be a mitigation block. It could be a liquidity void. Okay. It could be a BISI, a SIBI, a breaker. All of these are specific PD arrays. And they're all going to appear whenever price permits them to. Not every formation in price creates a fair value gap, but there will be a bearish breaker or a bullish breaker or a bearish order block or a bullish order block, or maybe there isn't a breaker in the current fractal that you're working with. You have to use the mitigation block. You see how we have to work with whatever price is allowing us to see at the time. That's what we work with. We don't force a perspective. We don't force the observation of a supposed setup. We demand it to be there in obvious terms. Okay? So going back into this level here, we can see on this particular candle here, the 7th, let me zoom in a little bit. This candle here represents this candle right there. Now this is a whole lot of business going on, so get this off. I'll take the fib off. Okay, so this individual candle here, this wick expanded up twice. That gives you the very high on the 7th. Okay, that's this scenario here. Another scenario would be this. If we get the initial candle to run up, say in this case, let's do it like this, 20 would be a good range of work because I can just do 10 on the next candle. That would be half. Okay? And on this candle, we don't care where the body is. We don't care where the open or close is. We don't care about that. We only care about where the midpoint is on this. So if we measured that body, open or close, to the high, there's your midpoint right there. Okay, or consequent encroachment. That right here is what we would see price want to reach up into on this candle. Okay, so it creates the lower high on this candle. Instead of this creating a higher one, if we bust through consequent encroachment on the initial candle, then we look for the expansion up, a double of the wick. If we don't go through the consequent encroachment, we use consequent encroachment as our objective to see time of day, to see if it is going to create, in this case, the high of the day. No, we don't get it there. We only have this one to work with here. Now, I mentioned in the rules that when we have the wick, okay, you expand out 4 days. So in this case, like say this candle here, you would go 1, 2, 3. This will be your 4th day. So you're going to count the next day as 1. 1, 2, 3. Okay, so expanding that out, you have a 4-day range in total, but you're using the next day to count as 1, 2, and 3. All right, so we have this candle, the initial high, we mark as consequent encroachment, and then we have the expansion of this twice, creates the very high on the 7th. Expanding out in 4 days, or 3 days out, 1, 2, 3, right here. We're using the range on this day and counting 1, 2, and 3. Spread that out in time and basically accomplish that with the lines I have here. If we drop into a 15-minute time frame and look at the 8th, here's the 8th. There's 2 levels here, and we're going to watch the reaction on this one, which was the initial consequent encroachment of the previous candle on the 7th. Okay, we're watching the reaction. Now watch this watch this level here. Okay. Boom. Fair value gap, and then watch, bang, hits it right there. Right there, look at that. high is 44. The level is 43.9, so 44 essentially. Fair value gap, rebalance, there's your trade. Trades right up into it. Doesn't get to the bearish order block. See that? It goes right to what I'm teaching you relative to the wicks. Now, this is a level that would be derived from the daily using what I just taught you. It's not pin bar theory. It's not Steve Nielsen candlestick stuff. It's IPTA price delivery. Okay, so if we go out to a daily chart again and we look at, well, this example right here. Same thing that we mentioned over here is happening here. Small little fair value gap. It's minor, I know, but it's still a gap. It trades up into it here. This candle's wick from the body to the high, twice that will give you this high. If you look at an example of, let's look at a different pair. Let's look at something I don't usually look at. Dollar yen. All right, so dollar yen. Let's zoom in, go to the daily. All right, so we have a low here. Let me go out and go back to a level where we have a rejection block, lowest down close candle, the close. That's what we're looking for. We're trading down into that. And we start looking at the wicks. Okay, studying the wicks. Zoom in. All right, so we have nice big candle, wick, broad, stabbing down below the rejection block. We have the range seen here, right there. So I'm measuring that particular candle, and the day is June 21st. So we'll drop down to a 15-minute time frame on June 21st. Okay. And here is your projection, and we use this level right here, which would be twice because we eventually breach consequent encroachment. So we're looking for 106.77 or 78 in this case. 106.78 or 106.77.5. Price trades down, hits it perfectly here. Does it go any lower? No. And that's a yen pair. I still hate yen. Don't get me wrong, I hate it still. But that's IPTA price delivery. What I'm teaching here is external range liquidity demarkers. And you don't see this in books. It's only mine. And it's something that I learned as a result of me working with folks that you're never going to meet. Okay, so the details are going to be more about how to use this stuff and how look for them. But I want you to go back, and this is how you practice. Go back out to a daily chart. Okay, and you can do this with stocks. You can do this with bonds, even crypto. Okay, I was looking at crypto today, and there's a lot of this still happening in that stuff too. Like if you look at Bitcoin, you can find examples of it as well. All right, so look at this low right here. All right, and I know right now you're probably thinking, man, this is not making any sense to me. You need to talk more about it. Don't rob yourself of the study. Okay, I want you to find examples of these and look into what you find and then compare with the rules I'm going to give you that's going to be black and white for you this weekend in the weekly review. All right, so we have the body here. What is it trading down into? Closure of the fair value gap. This is a BISI, buy side imbalance, sell side inefficiency. Trades down into it here. This wick right there. Okay. There's a midpoint. Trades to it here. Bang. Okay. Daily low formed on consequent encroachment of the wick that goes into the fair value gap. Perfect. Perfect delivery. All right. And now let's look at looking for fair value gaps and bearish order blocks. Sometimes you won't get any of this formation at all. In other words, much like we don't always get a breaker or we don't always get a fair value gap. If it forms, it's great. Then we have a way of interpreting where a daily high or low will form. But if it doesn't give us wicks to work within, then we can't do anything with it. We just got to use something else out of our repertoire. And again, it has to be an intermediate term price swing for it to have a lot of the signatures that would be expected using it. All right, let's go and see if we can find an example of this with gold. All right, so here's an example of gold. We're on a 4-hour chart, intermediate term price. We have our wick running equal lows, so it's an equal low liquidity pool, sell side liquidity pool being ran. And I'm going to use a horizontal line so you guys can see it's nothing trickery about it. Put it right on that line perfectly. So the level is 112.84, the low 112.84. Perfect. Once it hits it, boom. Now here's the wick. Now again, you're expending the time or the range out 3 days. So on the 4th is here. So every day creates wick forms here. Go out to a daily. Zoom in. It hits it here. So this candle to this candle here. Hits it, bang. You get this reaction trading up into the fair value gap here. Now this candle, we could do the same thing using consequent encroachment, but we don't get anything on the next candle. It's too heavy. It just trades down. So it wouldn't help us in this specific scenario here, but it does allow us to use it down here at an intermediate term price swing. Okay, every turn it's intermediate term, not little minute fluctuations. Now you can get crazy with this and study it on very short term time frames, and you can see it still because it's IPTA doing it. Everything about it is automated. But I like to use it on the daily, 4-hour, and hourly only. And other than that, I don't like to really worry about this particular concept. We have it again here. Again, this is gold. Here's that wick after taking out liquidity pool here. And we trade right to, I'll just move the horizontal line down to the midpoint on that dot right there. There's the dot. Price is 112.68. This candle's daily low, 112.68. And what does it trade up to? Trades all the way up into closure of a fair value gap and expands a little bit more into a mitigation block here. Okay. So everything's bouncing between PD arrays. Okay. Premium to discount, discount to premium. But these wicks, okay, are very telling. They're very transparent. When everything is there, you can see a lot of visibility in terms of precision. Again, it's a one concept thing. You can't make a system off of this and say, I'm going to pick daily highs and lows every single day. No, it's not like that. But this is one tool, one concept that I use to pick the very high and the very low of the daily range. When you blend this with the central bank dealers range, flout, and the Asian range standard deviations that we work with for intraday volatility, man, you cannot get any better. It's perfect. It's perfect. It's precise. And to me, I'm going to leave you with this. Go through your examples and study, okay, using the daily, the 4-hour, and the 1-hour chart. You're going to find a plethora of examples. I didn't want to rob you of the ones that you'll find because I just want to do a few of them. What I've shown you here is enough. And again, what I'll teach you in this weekend's lesson. But I want you to go through the charts and study it and start looking for these signatures that are there, because these swing points, okay, are highly engineered. You can't look at this stuff and not quickly come to the conclusion that they're rigged. These markets are 100% rigged. A free market, just trading out there at random buys and sells and no one is in control of price, you would not see these things occurring. You wouldn't. And this is actually one of the first things that I saw with going back home and looking at what I was being exposed to. I was like, there is no real randomness to any of these things. Like, this is 100% controlled. Then dollar signs hit me. Like, I knew that if I crack this, then I'll have a whole lifetime of being able to find setups that are profitable. And it led to more things and finding deeper signatures that are always in price action. They're always there. But they're at intermediate term price swings. Now, why does it have to be an intermediate term price swing? Because the smaller fluctuations aren't going to be like an opportunity for large funds, because they're not going to be able to, they're not timing their positions off of that. Now, daily and 4 hour they are. I like to use a 1 hour still because it allows me a little bit more refinement on a level that would be for a daily or a 4 hour chart, but I don't like to use it any less than that. Now, I'm not trying to discourage you to not use it yourself in lower time frames. I'm just saying, I personally, just like I don't personally swing trade long term, I don't position trade long term. I'm an intraday day trader to very short term weekly range trader. That's my forte. That's what I specialize in, and it fits my personality. Don't think just because I don't personally use it on a lower time frame that you shouldn't. You're going to find that there's a lot of precision still that exists by using it, but I'll leave it up to you to decide whether you want to use it. Again, dig into your charts, see what you can find. Let me see if I can pull one up on crypto. Let's pull up Bitcoin. I mentioned earlier on Twitter that everybody should be taking their profits on this. Let's see if I'm wrong. Oh, look at that. That's a big wick. Real clear. Oh yeah, that's yeah, that's always fun to see that. So yeah, wonder who listened on Twitter today about taking their profits and paying themselves. Hold. Yeah, hold. All right, well, here you go. Here's an example. Price is trading down here. There you go. Midpoint right there. And it's right on that dot right there, which is the 50 level. Consequent encroachment. And the low on this candle comes in at 11,092. 11,092. Boom. That candle right there. Off she goes. Here's another one right here. If we use the wick down to the low, move our little horizontal line here. Alright, let's zoom in. Make sure we get a clean measurement here. Right on that. Right there. Right there. Alright, so our level is our level is 11,214, and the low comes in at alright, so we put our level right here on that dot. Right there. Alright, so we're on the center, or consequent encroachment, at 11,212, and the low comes in at 11,212. And this is Bitcoin. And it ticks off. So again, pretty interesting. I find this more interesting though. Oh, I'm so bad. Alright, so anyway, that's that, folks. I will give you the opportunity to go through your charts and be astounded by it. Just real quick, I just want to toss up. Let's do crude oil. Alright, and let's zoom in. Alright, we have liquidity pool here. So there's liquidity below that. They're running below it here. Okay, so we're going to look at the wicks in there. This is a daily chart. All right, so we're going to measure the run below on the wicks. Okay, and then right there. All right, so the level is 50.95, and this candle's low comes in at 50.90. So it's only off by 5 ticks on crude oil. So not bad at all actually. And you can see it here visually. This is 2 times this wick to get that one, and you'll really get it like that as you go into it more and more, studying it. You won't be going in there measuring the actual point by point because you'll be using other tools to refine it. But this is the overall general setup to it. And then let's see if we can see any more on crude oil before we call it quits for today. Here's one. And then twice of it takes us down to that low, and then you get an intermediate term price rally. And let's go into a 4-hour chart. See if we get anything on this time frame. Really what I'm doing, my eye is looking at all the intermediate term price swings. No. Nope, not there. Here's one. Right in here. Trading it into a rejection block. Lowest down close. Right there. Boom. Trading through it. Measuring that. And the extension. We'll have to go into a lower time frame to get that. And I'll do that, and this will be the last example. And you pretty much have the gist of what you should be looking for. So March 28th, we'll drop into a 15-minute time frame. Right in here. And the swing target line right there. You drop that right there. And there you go. Really, really close to the low on the 28th of March. And then higher, 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 higher. All the way up to 66. So there you go. Like I said, these are one of my pet tools. Okay, you're not going to find this stuff in books. You're not going to find it in anything except for me. No one else talks about this. No one else has ever mentioned anything about this. The closest thing that if I put this out on YouTube, okay, folks are going to do this. They're going to say, "Oh yeah, it's that same crap that what's his name, Jason Stapleton's crew." They would talk about dynamic support and resistance, dude, where they do this, and we look at the wicks, and if it trades back up into the wick bottom of that, okay, that's going to be resistance. Sometimes that works, sometimes it doesn't. What I'm looking at is the actual specific price level. Again, I don't trade in supply and demand zones, okay, which are ambiguous. Where at in that zone are you going to be looking to take your trade? Inside of these wicks at intermediate term price swings, when they complete to a PD array, then and only then do I look at the wicks and I measure them, and it gives me consequent encroachment. Depending upon what pattern we have, if it's the higher tomorrow high or lower tomorrow high. In other words, if the candle creates the higher or lower, it doesn't make a difference to me. In other words, I'm willing to absorb some of the drawdown, but my trade will be nixed or removed if I breach the higher high expectation of tomorrow. And what do I mean by that? Because I probably just confused you. If this candle here, if I'm expecting it to trade here and then stop here, but it goes beyond that, I will kill it if it trades above this candle's high. I'll look to re-enter with this same level at another time. It helps me keep my losses very, very small and tight. It gives us rules to work within. Okay, and I'll give you those rules this weekend. It's very simple stuff. But for now, I want you to get in there, enjoy looking at these things occurring because they repeat a lot. And again, working with the daily, 4-hour, and hourly only. Once you've done enough of them, if you really want to, go nuts this weekend, but not until this weekend when you have a little bit more rules, go into lower time frames and you can find that they still exist on that. I mean, if we look at a 5-minute chart. I told you the video's about to end. I'm still going. I missed you guys. I hope you appreciate that. I missed talking to you. I missed listening to my own voice. So if we look at the what time frame is this? 5-minute chart. Okay, and there really isn't a whole lot to work within because there's a lot of noise. But if we enter in those areas where we had the intermediate term levels a bit identified with the fair value gaps and such. Let's go back a little bit more. We'll find one of the lighter colored ones. There you go. Right in here. Nope, you don't have it there. And it should be returned back up into that level later on in time. Here it is. So if we zoom in on all this business, and you can see it's not anywhere near as informative as it is on the intermediate term levels, daily, 4-hour, and hourly. Nope, don't really see it there. Nope, and I already mentioned this right here based on that daily level. So I think that's going to be it. If I say any more, it'll probably just add more confusion, and it's not my intention. I don't want to confuse any of you, but oh, that is so pretty. But anyway, you would think I'd be short, wouldn't you? But I'm not. But anyway, the levels that you're going to be studying are going to be significant only if we trade to the daily, 4-hour, or 1-hour PD arrays. Okay, again, at a premium level, when price is above the equilibrium price point of the current dealing range or whatever time frame you're trading in, daily, 4-hour, 1-hour. If it's above the 50 level, okay, or equilibrium, that you're in a premium, you're going to be looking for bearish PD arrays. Okay, use the PD array matrix, and if you haven't gotten that far in the material, just remember this video, make a note in your study journal when you get to the content that teaches the PD array matrix and how we break them down relative to the current price delivery and where you are in that range. Then this will obviously be much more meaningful to you as a lesson. But because I have to start going into new content, I'm just putting it out there in the teaching on the weekly reviews, so that way it's your job to make notations in your study journal when I refer to certain things, and then when I tell you how to pair them up with other things in the mentorship. Okay, so I think that's going to be it. But nonetheless, have yourself a pleasant remainder of the week. I will touch base with you again on the forum if there's anything of any real interest. Other than that, I will catch up with you Saturday at 4 p.m. by way of the weekly review. Until then, I wish good luck and good trading.